A broad rally in fixed income continued in the third quarter as investors did their best Goldilocks impression, seeking more yield without too much risk. The evolving economic tea leaves supported this mixture of moderate risk and caution as the Fed cut interest rates by 25 basis points in July and September. But manufacturing reports and international economies continued to show weakness. Layer on evolving trade tensions, impeachment investigations, and ripples in the repo market, investor conservatism seems warranted. During the third quarter, the United States Treasury curve continued to move markedly lower as the Fed lowered their target Fed funds rate twice and announced the early termination of the balance sheet runoff program. The long end of the curve outperformed as yields on the 10 and 30-year Treasuries fell and prices rose more than the yields on the prices on the 2-year and 5-year Treasuries. The yield curve remained inverted with the difference in the 10-year Treasury yield and the 3-month T-bill peaking in August at about 50 basis points. Curve inversion briefly spread when the yield on the 2-year Treasury traded above the yield on the 10-year Treasury for about a week at the end of August. With the Fed lowering the overnight Fed funds rate, the 10-year 3-month inversion has reverted and the spread is currently positive. In mid-September, a confluence of events created a short-term liquidity problem in the overnight repo money market. This caused the overnight Fed funds rate to exceed the Fed's targeted range. At first, analysts blamed the issue on several large new Treasury issues, combined with the September tax payment date. However, further analysis showed bank regulations and the Fed's balance sheet runoff program constricted the repo market, contributing to the shortage. While regulators are working to fix the capital rules and restore the repo market, the Fed has announced they are expanding their balance sheet until the new rules are in place and the market functions normally. The Fed chairman stressed this balance sheet expansion is not quantitative easing, their 2013 program to stimulate the economy. However, while the buying program is needed and the halting of runoff is important, it raises the question, will the Fed ever be able to reduce their balance sheet to pre-2008 levels, or is this the new normal? Corporate bond issuance was strong in the quarter as companies sought to take advantage of low interest rates and favorable terms in the bond market. Demand for these new issues was high. With low interest rates settling in, investors sought more yield, driving moderate quality BBB bonds to outperform higher rated bonds and lower rated high yield bonds. Even with the potential of recession and significant volatility in interest rates, corporate investment grade and high yield spreads remain within historical averages. However, with signals from the yield curve and the economic uncertainty, we expect high-rated corporate bonds to perform better in the event of a recession or a market downturn. The continued risk-off sentiment translated into positive cash flows for municipal bonds from both institutional and individual investors throughout the quarter. According to the Investment Company Institute, municipal bond funds received $19 billion in new money and a record $66 billion for the year so far. Municipal new issue supply picked up in the quarter as municipalities rushed in to capitalize on investor demand and lock in low interest rates. 2-year AAA rates were unchanged at 1.22%. 10-year rates were lower by 17 basis points to yield 1.44%, while long-term maturities performed best with rates lower by 28 basis points to 2.02%. We expect tax-free rates to remain near these levels for the balance of the year as we continue to see strong demand for municipal bonds. Looking into the fourth quarter, we expect bond markets to stabilize. Uncertainty continues to increase and investors continue to seek out fixed income to reduce the risk in their portfolios. The inversion will continue to ease as the Fed has stated their intention to support continued economic growth and likely will cut rates at their October meeting. However, reversion doesn't get the economy off the hook. Looking at previous inversions, the recessions that followed typically happened several months after the curve reverted. Risks to our outlook include an end to the GM strike, Boeing restarting production, and a breakthrough in trade negotiations, all renewing hopes for a strong economy, and with it, concerns about inflation and higher interest rates. But without a trade breakthrough, shrinking manufacturing activity could weaken employment, hurt consumer confidence, and set the stage for a 2020 recession. If a recession looms, we would expect a rush to safety with Treasury yields falling and corporate bond spreads widening. High-quality municipal bonds, traditionally more recession-resistant, may outperform as investors seek safe, tax-free income. To learn more about what is a yield curve, what is inversion, and why it happens, we have 2 links below, a short video explanation and an in-depth analysis. For more information, please contact Ross Sinclair Asset Management or visit our website. Thank you for joining me for this quarterly update.